Welcome to the Daily Update Podcast, where I'll go over the action in the market for Tuesday, July 29th, and we'll see how things look for Wednesday, July 30th. On Tuesday, the S&P 500 gave us a subtle but telling signal. As has been happening lately, the S&P opened higher, pushing above R1 at 64.02, setting an intraday all-time high. However, the momentum didn't hold. Prices drifted lower, closing down 0.3% after dipping below the S1 support level at 63.77. We finally found support at S2 at 63.42. This pattern, earlier highs followed by a fade, has persisted for a few sessions, a classic sign of an exhausted market. Trading volume was above average, reflecting heightened activity as investors brace for a packed week of economic data, earnings, and policy announcements from the Fed. Despite the decline, the S&P remains above the 20-period moving average, preserving a positive short-term trend. However, a break below this level could shift sentiment to a more bearish stance, so it's a critical threshold to watch. Looking at the sectors, growth stocks took a bit of a hit on Tuesday, underperforming as investors leaned more into value stocks, signaling a short-term shift towards a more defensive posture. We've seen this developing over the past few weeks. Tech held steady, but discretionary and communication lagged. Meanwhile, defensive areas such as real estate, utilities, and staples showed resilience. This rotation suggests caution as the markets digest the possibility of volatility ahead. Looking at the economic reports, consumer confidence came in at 97.2, above expectations of 95.5, improving slightly from the prior reading of 95.2. However, it's still below last year's reading of 101.9, and expectations remain below the critical 80 level looking out, hinting at lingering recession concerns. Inflation expectations also eased slightly to 5.8% from 5.9%. On the labor front, the JOLTS job openings disappointed at 7.437 million, down from the previous reading of over 7.7 million and below forecasts. Housing data showed some divergence. The FHFA Housing Price Index rose 0.2%, defying expectations of a decline, while the Case-Shiller Home Price Index increased 2.8%, short of the anticipated rise of 3%. The Advanced Good Trades Deficit improved to 85.9, a positive sign for trade balances. Geopolitically, tensions continue to simmer. Comments from President Trump regarding secondary sanctions on Russia if the Ukraine conflict persists beyond August 8 is adding uncertainty. Trade deal deadlines, including those on August 1st, are also looming, with the markets closely watching how tariffs and negotiations unfold. So far, many tariffs appear to be absorbed by foreign companies, but the full impact remains unclear. Looking at the technical side and market sentiment, from a technical perspective, the S&P is flashing overbought signals across multiple indicators. The short-term RSI, the CCI charts, and the CMB composite remain extreme positive, though they are declining. The Stochk RSI has dropped off our list of extreme positive short-term indicators. The bullish percent index for the S&P has eased and is now turned negative, dropping below its moving average, but the NASDAQ 100's bullish percent index is now climbing and is extreme positive. Momentum indicators continue to show cracks. The balance of power and TTM squeeze indicators are declining, showing negative divergences, and short-term oscillators, including the Swinland Trading Oscillator, are negative. The ADX is still near 40, a level that often signals exhaustion, though we're not quite there yet. Volume-based indicators, including the advanced decline line, remains positive but are softening, and the VIX ticked up slightly, hinting at rising caution. Sentiment is still positive but cooling. The fear gauge dropped to 69 from 74, no longer extreme, but it's a number to watch. If it continues to decline, it could align with further market weakness. The S&P 500 is still in an uptrend, characterized by higher highs and higher lows, but the negative divergences in the short and intermediate term indicators suggest we're possibly at a crossroads. Looking at other markets and corporate trends, oil prices rose, likely tied to geopolitical risks involving Russia. The US dollar continues to hold above its 50-day moving average. Meanwhile, the 10-year Treasury yield dropped significantly to 4.33% from 4.42%, though this did not help stocks. The 10-year to 3-month yield curve is back to being inverted again and giving a potential recessionary signal once it goes uninverted. On the corporate front, earnings sentiment remains broadly positive, with optimistic outlooks driving valuations. However, we're seeing signs of overextension. Revenue per employee is up, capital expenditures are rising, and leverage is at historic lows. Those are all positive. Buybacks surged 16%, dividends rose 6%, and M&A activity jumped 23%, reflecting corporate confidence. Yet housing affordability remains a challenge, with a 20% down payment now equating to 100% of annual household income, a stark reminder of economic pressures. Looking ahead to Wednesday, the market is gearing up for a pivotal day. The Fed will make their announcement at 2 p.m. Eastern Time. No rate cuts are expected, but the statement and subsequent press conference will be dissected for clues on future policy, especially amid debates over tariffs and U.S. debt refinancing. President Trump's push to lower rates to ease debt costs clashes with the Fed's focus on economic fundamentals. Economic data will also keep investors busy. The first look at the second quarter GDP, ADP employment figures, the weekly MBA mortgage applications index, and pending home sales are all on tap. Earnings season continues, with 38% of S&P 500 companies reporting this week. Seasonally, July 30th has historically been neutral to negative for the Dow, but positive for the S&P 500 and NASDAQ going back to 2002. However, August in post-election years has a bearish track record, with an average return of a minus 3.4% going back to 1950. While trends can be bucked, this historical precedent warrants caution. In conclusion, the S&P still remains in a positive trend, holding above the 20-period moving average. But Tuesday's pullback and overbought conditions signal potential weakness. The Fed's commentary, upcoming economic data, and geopolitical developments will shape the near-term direction. For now, this looks to be a healthy pullback within an uptrend, but a break below key technical levels could shift the narrative. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.